This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Has the tail started wagging the dog? Is the U.S. the dog? Is China in a downward spiral, or is it about to hit the afterburners? These themes are shifting, and we'll talk about them all on this week's Wise Investor Show. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein. It felt like an explosive week in the markets. Maybe it wasn't as dramatic in the end as it felt like sometime intraday. It culminated with a very strong jobs print this morning when it was announced that the U.S. economy added over 300,000 jobs in March, where the expectations had been for just roughly 200,000 jobs. And average hourly earnings jumped by over 4%. And that might have helped seal the primary narrative that's brewing and bubbling over this week, one which we started with last quarter, really. But the narrative is that while the consensus is still for interest rate cuts this year, the expectations are for far fewer than the street expected at the end of last year. And there's a growing argument that there could be no interest rate cuts as inflation remains stalled well above the Fed's 2% target, and the economy is not calling on the Fed to cut interest rates to avoid any kind of problem with rising unemployment. We'll talk more about that. Higher for longer is definitely the primary talking point right now, and the markets aren't thrilled as they've dropped about 2% for the week so far, starting off the second quarter with a bit of a sell-off after the first quarter, which was largely, I think, just carrying the momentum to end last year. The first quarter saw the major indexes rise about 10%. Of course, this employment data is one blip on the radar, and the Fed's dot plot is still calling for a few rate cuts this year. But there have been plenty of blips on that economic radar in the first quarter this year, ones that were largely ignored as capital just continued to pour into the markets, driving the prices and valuations higher. So a good deal of what we saw this week with the broad indices down a couple of percent and some of the more popular high-flying stocks for the year selling off more than 5% in some cases, that was really already brewing, but didn't bubble over until the end of the quarter. And those that control and deploy the capital out there then decided what their next move was going to be now that they've banked two big consecutive quarters with big gains in their portfolios. But to digress for a second to a completely different topic, well, not completely different. I'm not going to start talking about baseball, but different portion of the economy at least. Another narrative, though, which is becoming part of the daily market chatter here. The markets are positioning for what they expect to be a major round of stimulus, accelerating growth, and growing consumption coming out of China. Now, this is coming from two main sources. One, China has been doing the opposite. They've been struggling with their economy growing far below their own targets. But two, in an attempt to address this issue, President Xi gave a speech which apparently had been widely misinterpreted in the West, where we thought he was calling for looser lending regulations and a coming wave of stimulus. But that's been somewhat walked back this past week. In fact, as Bloomberg reported after President Xi commented on the local financial markets, quote, according to Bloomberg's quote, the remark was on adjusting credit structure, and it was actually meant to serve as a technical adjustment, and it appears that Xi was giving his view on how the People's Bank of China could fine-tune its market operations and not ramp up purchases of government bonds to flood the economy with liquidity, end quote, more or less, according to Bloomberg. However, something is expected and needs to be done. As The Economist described China's economy in an article this week as, quote, its famously industrious workforce is shrinking, history's wildest property boom has turned into a bust, and the global system of free trade that China used to get richer is disintegrating, end quote. The article goes on to point out that 20% of China's workforce will be gone in 25 years. So China has a very serious long-term structural issue that it needs to address. And perhaps their global expansion and tampering and tinkering and in cases invading is reminiscent of early 20th century Japan's tenuous hold on an expansive empire. But in terms of the near term, it is generally expected that China is going to try to stoke the fires and get things moving again. And this is evidence in what copper prices have done lately, as good old Dr. Copper is anticipating a boost in global demand, a good deal which goes into Chinese electric vehicles, for example, as copper is actually up 10% already for this calendar year, up almost 5% just over the past week or so. Now, this theme is reiterated in a JP Morgan report this week, pointing out that their measures of global PMI and their estimates for the global economy are accelerating, and also a Goldman Sachs report from March, which said that copper will be up over 50%, up 50% higher in 2025. And that report demonstrated that in the 12 months after global manufacturing historically troughs, which is what they're saying we've now just recently seen, the price of copper, zinc, and nickel are historically 25% higher in the next year, and aluminum is historically 9% higher, using over 40 years of data. More importantly, that Goldman Sachs report points out that while it remains to be seen if China is willing to support their ruined property investments in the economy, they are pushing still a green agenda, which itself specifically puts a high demand on these metals. Now, JP Morgan's report points out that the recent global PMI report, a measure of net growth in the global economy, is building momentum from the previous months. And they say that a perceived, quote, dip in global industry at the start of this year will be short-lived, end quote. They go on to point out also encouraging signs throughout Europe, except for Germany, but also throughout Asia, beyond China. And you may remember a couple of weeks ago, I touched on the shift in long-term policy in Japan as that economy now draws itself out of this long multi-decade downturn. While these are good signs for the global economy, they come at a cost. You know, in the U.S., we've benefited from the normalization of global trade and supply chains both being repaired and being backed up through redundancy. And we've also imported deflation from Asia, allowing us to enjoy this Goldilocks scenario with lessening inflation in the U.S., but also strong economic growth and employment at the same time. But the easy part is over now, and now the period of global good disinflation tailing off, service inflation in the U.S. needs to be conquered, which is harder to do while also retaining that strong economic growth and maintaining low unemployment. Also important to the Fed is that housing remains very challenging for Americans right now and is actually a major component of our inflation measures. This global story, the rising demand for industrial metals, that can and may contribute to inflation in the U.S., but it's actually not nearly as big a portion of what drives U.S. inflation compared to housing. I'm going to take a quick break here, but when I return, I'm going to get a bit more into what is still the sticky wicket for us and some alternative approaches, some contradictory theories to address it. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be back with that in a moment.
The political temperature is only going to get hotter. It doesn't mean you need to lose your cool and make emotional decisions. I'm Simon Hamilton, Managing Director and Portfolio Manager with the Wise Investor Group of Raymond James. Every week we discuss the latest financial trends and what investors need to know. To help filter out the noise distracting you from sound portfolio management and how to become a better informed, wise investor, listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. So we had a first quarter for the stock market that saw prices rising roughly 10% for the major indexes. And we saw dampening but persistent expectations for interest rate cuts. And then we turned the calendar, and this week brought on what has been actually the worst week for the Dow Industrial Average since March of 2023. And I think a big part of this was that at the end of the quarter, while the writing was on the wall, we were already seeing plenty of signs in the really more than a month leading up to the end of the quarter that the stimulation of interest rate cuts were not going to be as big or as soon as had been hoped when the year began. But many investors were just willing to hold their noses before repricing their strategies and waiting until the quarter was over. But now, this past week, it was also could be characterized by, let's say, a parade of Fed governors out there, out and about, giving interviews publicly about what their thoughts are. And they do this in a very calculated manner, as they deliberately want to manage the expectations of the capital markets while trying to attend to their dual mandate. One interview that struck my interest was from Austin Goolsbee. He's the current president of the Federal Reserve Bank of Chicago. He's one of those dots on the plot. And he said that the biggest inflation risk is high housing costs. Also, though, he's watching consumer delinquency rates as a key sign that the Fed may stay too high for too long. And he's also said that he's not dismissing the January inflation numbers as an anomaly. But so he's now walking this fine line. He's watching signs for trouble in those delinquency rates, which are not notably picking up yet. But he's also prioritizing that inflation, primarily housing inflation, is still a very real problem. But this raises, and it did raise on CNBC that day, it raised this key debate of how do you fix housing prices? If you keep rates high or take them higher, well, eventually you'll really do damage to the economy, and that would reduce the demand to an extent for houses. I mean, people still need to live somewhere, but at the very least it reduces the aggregate ability to buy and pay higher prices, which drive home values and rental rates higher. I guess everyone, or a good many people, will move back in with their parents to some degree. But somewhat counterintuitive to raising interest rates to battle inflation, reducing some interest rates may also alleviate that element and a very big element of inflationary data that comes from housing demand. What we're generally all talking about on a daily basis is the Fed's ability to lower very short-term interest rates and the trickle effect that has on other benchmark rates through the economy and the availability of capital that it makes through the economy. But housing's a bit different in that it's largely driven by long-term interest rates, which affects big capital borrowing. If I want to build a new subdivision, I'm likely going to be leveraging up to borrow that. So that's long-term interest rates matter there. More importantly, though, of course, it affects mortgages. And lowering mortgage rates can make a home ostensibly more affordable, and that a borrower can afford more house for the same monthly payment. But then that can also be counterbalanced by increasing the demand or the prices that people are willing to fight over for a limited inventory of houses, which lower rates may then drive prices higher. However, the reason that lower long-term interest rates can and I think do ultimately benefit home buyers and renters and this inflationary effect, is that it frees up capital for the home builders, as I mentioned, but more importantly, it can unleash a lot of existing homes that are bound up today by ultra-low mortgage rates and leave more and more of these owners willing to sell if we see rates come down a bit. As rates become more tolerable, albeit not at the near zero levels we saw a few years ago during COVID, but as interest rates, long-term rates come back down, the existing homeowner may, and incrementally more and more will, become more willing to pack up and downsize or move to a warmer climate or whatever the story is that they're unwilling to do today because their carrying cost of the new property is just too much and they can't give up that current home, even if they have an intention to move on. But the trick, though, is that the Fed cannot dial up or dial down long-term interest rates, but they can impact them. They can control how much money banks are required to hang on to and therefore not lend out as easily. And they can control how much cash these banks have in total to a degree. But they also tinker with things through quantitative easing or quantitative tightening. And recently, they have been quantitative tightening, allowing this stockpile that they've amassed of treasuries and mortgage bonds to mature without them buying them back, shrinking the Fed's balance sheet. But that has the effect of allowing long-term interest rates to rise. They might not be able to drive mortgages back to that maybe a 5% rate anytime soon. But what's to be read within what folks like Mr. Goolsbee are saying is that what they need to really consider is pausing quantitative tightening efforts for now. He didn't say that specifically, but I'm reading that within his comments. And that is what I'll be looking to see specifically highlighted within the June Fed's meeting notes when they are available. Now, many of the other Fed presidents are out there trying to reduce expectations for broader action this year, at least for a bit in the U.S., where growth remains surprisingly strong, as we saw in that Friday jobs number. Atlanta's Fed president said he would favor just one interest rate cut this year. Fed Governor Waller gave a speech titled, quote, "There's still no rush," end quote, meaning no rush to cut interest rates. He said, actually, in that speech, quote, "I'm going to need to see at least a couple of months of better inflation data before I have enough confidence that beginning to cut interest rates will keep the economy on a path towards 2% inflation," end quote. Now, and Fed Chair Powell also noted at the end of last week that there was still no hurry to cut interest rates since the U.S. economy is continuing to prove to be resilient at these supposed restrictive levels. And this makes sense. It really does look like we're due to get some cuts this summer, but the data itself isn't calling for it, and they're supposed to be data-driven. And what would or will cutting interest rates bring other than higher stock prices? While now we'll still, if we did cut rates 50 basis points, we would still remain above that so-called projected neutral rate. We would still be in a zone where interest rates are, to some degree, maybe a lesser degree, fighting inflation. But by easing now, of course, you're reducing that effort. Also, cutting interest rates will lead to more lending, more growth, more jobs, and more inflation. Right now, what the central bank wants to see is less inflation, not more of these things. So what the argument for them to cut right now, other than Wall Street whining about it and pricing in and believing that the cycle has taken long enough? Wall Street just says, all right, it's been long enough, let's see interest rate cuts. But Wall Street really is, in no hyperbolic terms, is addicted to cheap money after what it's grown accustomed to over the last 20 years. And over the past 10 years, turning onto the really heavy stuff, if we continue the addiction analogy. But from 10,000 feet, the economy just isn't calling for easing monetary policy. What we really may need to see to keep on track this year isn't the lowering of short-term interest rates, but the focus on reducing interest rates at the longer end of the curve. The question I have now, though, is the tail wagging the dog? In that, is Europe going to beat us on inflation and lead us on cuts? Traditionally and throughout this upswing in interest rates and through this cycle, the U.S. has led the way, and most of the world, at least the developed world, follows in suit. And if not, they would otherwise see their currencies devalued and inflation really taking hold. So the U.S. has always blazed the path of where monetary policy is going, and the rest of the developed world follows us whether they want to or not. But recently, the European inflation data has been much more benign than we're seeing here in the U.S., and it might be the EU's willingness to cut interest rates before us that leads us to getting those initial cuts, when what I'm arguing here is that we really don't deserve them. The annual inflation rate across most economies in Europe eased for the third month in a row, nearly the target set by the European Central Bank. Consumer prices in the 20 countries that use the euro rose just by 2.4%. So they're doing better over there, and they might be leading the path to where we see what Wall Street wants, but maybe the U.S. economy doesn't ultimately need. Certainly more data coming out on that in the months ahead. All right, so big inflation data coming this week. I think Simon's scheduled to be on the show next week. Someone will be talking about that soon, CPI data next week. That will certainly be continuing these narratives and having an effect on the capital markets, where the momentum recently certainly seems towards the downside. More to be seen there as well. That's it, though, for me this week. I appreciate, as always, you tuning in. I'm Chase Hinderstein for the Wise Investor Show. Have a good week.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide, and should not be relied on for, investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.